Hey traders, welcome to the Seneca Analytics Trading Academy webinar. So we're going to start off by running through our methodology, and then from there we'll move on to looking at some charts. I mentioned in the latest tweet and latest email that we're going to look at the S&P and how we pick the top and why we think the bottom is in. Then we're going to look at the dollar a little bit, and then we'll move on to just discussing the beta test and showing you what's in store for you guys if you look to joining us. So basically, our methodology is an amalgamation of Elliott wave theory and classic charting. So with Elliott wave, if you guys are not familiar, he basically talks about price waves, how price moves in waves. And he talks about impulses being 5-wave moves with 1, 2, 3, 4, 5, 1, 3, and 5 being impulsive moves in the direction of the trend, and 2 and 4 being corrective waves. Then he also talks about corrective patterns at the end of each price wave, which he calls ABCs, or also ABCDE when it comes to triangle patterns. Okay, so Elliott wave theory talks about price waves 1, 2, 3, 4, 5, and ABC corrections. In classical charting, it's all about identifying these corrections, the most common being the head and shoulders, left shoulder, head, right shoulder. And when you see these patterns, historically, they've done back testing, and these patterns have resulted in a certain kind of price action following this, with a high probability of the same price action following that same path moving forward. So we've kind of combined these two things into what we use as our methodology. So I'm going to break down this methodology over the next 45 minutes to an hour. And what's going to happen is, well, we're going to try to break this down. I mean, this is way more complex than what I'm going to try to show you, but I'm going to try to show you in this hour how powerful this methodology is. And once you join our academy and you start to learn this for yourself, how you can really start to analyze charts at a completely different level compared to those of guys who just follow Elliott wave or just follow classical charting patterns. And the very basics of what we do is kind of foundational in Elliott wave. So where he talks about patterns and price moving in waves, we follow the same thing. So we see an impulse, we look for a correction, and we know to follow is going to be another impulse. So the whole idea of how we trade, to break it down into its simplest form, is that we have an impulse, we look for a correction, and we then trade the next impulse to the upside. That's the very basics of what we do at Seneca. And how we go about doing that is we need to identify the impulse. And once we've identified the impulse, we need to identify the correction. And once we can really get into the meat of this correction and dissect what it actually is and what it's doing, we can then find an entry point to trade the impulse to the upside. And what we're looking at from this point of view is the very basics of what we're trying to do. And then following that impulse, what we'll either see is another correction. And I'm drawing these corrections in this way for a specific reason, which I'll get to later. We'll see another correction. And if we see that, we'll more than likely see another impulse moving forward. Or after this impulse, we'll see an impulse to the downside, meaning that this phase of price ended its own structure and then be starting a new structure to the downside. So it's all about identifying price waves, then identifying the surrounding structure of those price waves so we can trade with the highest probability of knowing which direction we're headed. Another important aspect of our methodology is what's called the fractal nature of price. And I don't know if you guys are familiar with fractals, but basically what a fractal is if you think about a tree, and a tree has the main stump, the main trunk at the bottom. And then from that trunk, you get branches that come off that trunk. something like that. You're going to have to just work with me here because I don't have the right tools to draw a tree. And then from the main branches, you'll see kind of secondary branches coming off that. And then all the way towards the leaves, you will see kind of the smallest branches which have the leaves on it. And if you had to take a camera and zoom right into these branches that have the leaves on them and take a photo of those tiny little branches, but then also take a photo of the main trunk close up, it would be difficult to distinguish between the two. So on the outside, you'll have these branches that kind of look like these branches, that look like these branches, that look like these branches. If you guys understand what I'm trying to get at. That's what fractals are. You can look up fractals in your own time. But that's kind of a simple example of what they are. And how that relates to price action is that this impulse, correction, impulse, or what Elliot would term 1, 2, 3, 4, 5. We don't actually use the count 1, 2, 3, 4, 5 because we've seen that on lower time frames, especially, you will see a 1, 2, 3, 4, 5, 6, 7, or sometimes 9 waves. So we try not to use the count, but we still use the kind of foundation of the count where you have an impulse, correction, impulse, correction, impulse. But back to what I was saying about fractals, how we have a 1, 2, 3, 4, 5, but each of these waves itself will be broken down into smaller price waves. Something along these lines. So you'd have an impulse, a correction, an impulse. I'm going to show all of this on a real chart moving forward. I'm just trying to give you an example, a clear understanding of what it is we're looking for. And you'll see, so this impulse is actually broken down, or can be broken down, into its own structure on the lower time frames. So this itself becomes a 1, 2, 3, 4, 5. So we have 5 waves up on a smaller thing, and on the larger time frame, you'll see it's also 1, 2, 3, 4, 5. And even if you had to delve into this one, you would find that the smallest impulse has a 1, 2, 3, 4, 5 in it as well. And that's the fractal nature of price patterns, and that fractal nature becomes very useful to us in trading because we can analyze the higher time frames, and then using those higher time frames, delve into the lower time frames to trade the lower time frames, knowing the surrounding structure. And you'll find at the end of a big impulse, let me just clean all this up. At the end of a big impulse, you'll find a big correction. But the fractal nature of these corrections also comes into play. So you'll find that these corrections themselves have an impulse, corrective price action in the middle, and an impulse. So not only do we trade these impulses, if you're looking at different time frames, you could also trade, we don't trade the first corrective impulse, which is known as the A wave, but we do trade the C wave because we know since we had an A wave, we need to have a C wave that kind of matches its characteristics. So A waves and C waves are impulsive in nature, and B waves are considered very choppy price action. So if I'm losing you, don't stress too much. I'm going to delve into the charts now and show you exactly what I'm talking about. I'm just giving you an overview of what it is that we look for when trading. So it's an amalgamation of Elliott wave, because we look for these waves, these impulses, corrections, impulses. But then using fractionality of price, we look for patterns within patterns to trade. And this is exactly what I'm talking about in real price action. So this is the pound dollar weekly chart. And I'll show you now how what we have is an impulse to the downside, corrective price action, and an impulse to the downside, followed by what we're currently experiencing at the moment, further corrective price action. So every impulse is followed by a correction, and every correction is followed by an impulse. And we know, because we have corrective price action, what's to follow once this correction is complete is further downside for the pound dollar. And talking about the fractal nature, if you look in to the correction itself, what we have is a corrective impulse. Within the correction, wavy price action, followed by a corrective impulse out. And this would be your A, B, C. So now this is our weekly chart. And if we had to go into the daily chart, we can start to show the fractal nature of these price waves. So as you see from the top, we have an impulse. We have a correction. We have an impulse. We have a very messy correction at the bottom. And we have another impulse. And then delving into the impulsive correction, or the A wave, we have the same characteristics. We have an impulse. And I'm going to make this green to show you that it is a corrective impulse, what we call a corrective impulse. We have a correction. We have an impulse. We have a correction. And we have an impulse. So you start to see how these patterns break down fractally. And I'm going to show you how we use this. So first of all, let's talk about, so we have this impulse correction impulse. So what becomes important in trading this price action is identifying what these impulses are, and secondly, identifying the corrections. And that's the most important part. So if you can identify a correction, and these corrections we have different types of corrections. So similar to classical charting, where you have triangles, head and shoulders, and things like that, we have our own category of corrections to know exactly what we're looking for and when we need to enter the trade, and when we need to, where we can set our profit targets and things along those lines. So you would see we have the ABC, and in this instance, we have what's called a contracting flat. And moving forward, this, we would have to delve into it, but it looks a lot like an expanding triangle. This is what's termed a running flat. And once you can start to identify, we have, I think, 5 or 6 patterns that once we learn to identify the characteristics of those patterns, we know exactly what we can expect from price action. And once we see what price action is doing and it confirms our suspicions of what the pattern is that's playing out, we can then get in to the trade at the right setting or at the right spot to maximize our profit at this highest probability. So I want to show you how we broke down this particular chart to get a 20% return on a single trade, and currently sitting at 4% in the opposite direction right afterwards. So this is the power of this methodology, because we know exactly what price structure is doing. So we know on the wider term, the wider structure, we have an impulse, a correction, an impulse, and we are now in corrective price action. So focusing on this area here, I'll show you 2 trades that we've taken that, like I said, the first one gained us 22%, which was a big trade for us. It's our biggest of the year so far. And we are currently in the return trade, which should bag us even more if things play out as we suspect. So delving into the lower time frame, we know what we're looking at is an impulse. What we have here is a corrective impulse. And what we expect moving forward is a corrective impulse to the downside. And delving into what this is, A, B, C. Delving into this middle section, which is the B wave, you would find this too can be broken down into an impulse, an expanding triangle, and an impulse. So following the same dynamic, impulse, correction, impulse. And on the outer structure, we have impulse, corrective B wave, and we have an impulse to follow. And delving into this area here, I'll show you exactly how we got the short trade to the downside to get our 22% on a single profit of this, or a 22% trade off of one, or saying 22% profit off of a single trade. And it's the same, following that same structure of impulse, correction, impulse. So we break down this area into, we have an impulse, we have this correction, and we have the impulse to follow. But because we know the surrounding structure on the higher time frames, and we're expecting an impulse that looks just like this, we know that the impulse to follow this correction should be much larger than just a simple C wave. And that's exactly what we got. We got a huge move to the downside in pretty much a straight line. It doesn't always work out to be so clean, but for this instance, it was as clean as it comes, and it was a great trade for us. And if you had to delve into this middle section, I'm going to go to the 8-hour chart just for more clarity. If you delve into this middle section, you'll see the same pattern playing out. We have, we'll make it purple. So we have this impulse, we have a correction, and we have the same impulse to the upside. So on a lower time frame, we have an impulse, an A, B, C correction, followed by the impulse. So we took this trade to the downside, and I'll show you the higher time frames once more. And because we have the surrounding price structure, we have this impulse, and all of this was corrective. But within this correction, fractally, there's an impulse, a correction, and an impulse to the downside. So we were trading this impulse to the downside. We got to the bottom, knowing that we still needed, or we still need to see this wave, or the C wave of the higher correction. So this is how we traded it and how we flipped our picture. And we're currently sitting 4% on the return trade. And this is where the classical charting comes in. So we have a bottom here, and we have quite clearly what's called a triple bottom in classical charting. A triple bottom on and MACD divergence. And how does this fit our bigger picture? Well, we know on the larger time frame, on the daily chart, we are looking for a turn in price in this area. So on the lower time frames, we're looking for something that indicates a turn in price for us. So we're still in this short, and we're looking for an indication that we've turned. And we see the triple bottom, and we have an impulse off the bottom, which we don't trade. And I'll make this yellow. We then have another impulse to the downside. We have some choppy, it's quite impulsive, so it was difficult to determine. And like I say, when you go into the 60-minute charts or the lower time frame charts, it becomes more difficult to identify price waves. But what we see here, which I mentioned earlier, is a corrective running flat. So what we did is we trailed our stop loss from the previous trade, from this trade to the downside. We trailed it to here, but at the same time, we put an entry order at the same level, knowing that if we get stopped out, we'll take our profits. And because we're getting stopped out, we want to enter because we know we're expecting a turn at these levels to head to the upside. And if you see what we've gotten from the bottom is an impulse, where the bottom is actually here. We've gotten this impulse, and now what we're looking at is a correction. And what we've showed many times before, what we expect to follow, and what it looks like we're starting to get already is an impulse to the upside. So as you can see, going from the widest time frames or the weekly charts, we know we have impulse, correction, impulse, and we're in a corrective phase. Then delving into the corrective phase, we know we've had a corrective impulse. We've had this correction in the middle, which we traded to the downside, and now we're expecting the corrective impulse to the upside. And if we see price heading up to this level, we'll be more than happy with the long trade. And at the same time, we're going to be looking for the same thing where we have a short entry order trailing along with our stop loss that will take us out in profit. Our stop loss is already in profit, and we want to trail the stop loss behind all corrective price action, waiting to see an indication that we're going to turn, because we know on the higher time frame what's to come is another impulse to the downside. And what's great about, and this has been showing on pretty much all the charts, is that we've just exited a phase of longer term B waves. Now, B waves are always the most choppy price action you'll get. So we just exited a phase of choppy B wave price action, and we're heading into C waves. So C waves are always impulsive. So we're going to see C wave, impulse, and then after every C wave, we see an impulse. So it becomes impulse, impulse. So we're reaching this phase in the market where we're seeing impulsive price action rather than this choppy corrective price action. And we're seeing this in a lot of charts. So that, I hope, is not too confusing. It's a lot to try and fit in to such a short time period, but this is basically the foundations of what we look for in our trading. And it really is just all about seeing the impulse, seeing and identifying the correction, and entering the trade in the following impulse. Knowing that each of these corrections at a fractal nature has its own impulses within it, which can also be traded. So that's the basic foundation of what we do at Seneca. And I just showed you 10 years of research in an hour. So it's difficult for me to get that across to you, but joining the beta program, I'll be able to teach you step by step exactly how we identify price waves, how we identify corrections and impulses, how we identify the different types of corrections and what to expect moving forward. And once we've identified these corrections, how we get into the trade, how we use risk reward and money management, how we get into the trade itself, at what area, at what levels, what do we look for before entering. So it becomes quite an in-depth process, and this is why we need these beta traded testers, so we can kind of sound off you guys the best way to teach this, because it is quite a complex thing to teach. And once I can learn, or we can learn how to teach you guys, we can then release that to the general public. So this is why we're giving you that $99 special, where you pay $99, you help us develop this this methodology of teaching this, and then you get lifetime access to that program moving forward. And obviously, being early in the game, we'll get to know you much better than when the group starts to grow, and we can help your trading along the way. So to us, this is a great deal and really useful for you guys. So if you're interested, you just click on that senecalytics.com/beta. You can find it on our Twitter page. You can find it in that email, and you join there. So I'll show you this methodology now, how we pick the top in the S&P using this exact same methodology. And I'll show you why we're looking at dollar weakness looking forward. So you might be able to get some trade ideas out of this if you stay in touch and just stay with this methodology. So what we're looking at here, I'm going to show you the most basic breakdown. There's a more complex breakdown of this, but I'm going to show you the basic one. It's the same story. We have an impulse. We have a correction. And what's to expect it moving forward is an impulse. So this is why we've called for new highs on this market. While everyone is calling this the beginning of the bear market, and this move is just a bear market rally, and we're going to see a big drop moving forward, we completely disagree with that notion, and we should expect new highs moving forward. So breaking this down, this correction, using the same methodology before, we have this corrective impulse. And we know, because this is the A wave, we expect a B wave and a C wave to follow. This B wave has its own impulse correction impulse. So basically, from December 2018, seeing this move to the downside and then a big drop pop up to the upside, we knew what we were looking at was an A wave. And then once we had this price action followed by another impulse, we knew what we were going to see is this: a big move to the downside to match the A wave, which it obviously far exceeded matching. It kind of doubled that wave, which happens and becomes what we call an expanding flat. And because we've had this expanding flat, there's a good chance we're going to see a strong impulse to the upside. I mean, it's possible we have what's called a fifth wave failure or a wave failure where we don't see new highs, but this impulse to the upside fails and then we see a big turn to the downside. But that's a different story. But I want to show you, so from our tweet, and I want to show you what I like about Twitter is that we have a timestamp of this. So on January 9th, 2020, we said, along with some other things, because we saw some fundamental stuff in as well, where the S&P shorts were at lows equal to the December 18 correction, which is a good indication that we're going to see a drop, and corporate profits at flatlined, which also shows there's room for a drop. And we said it's a good time to get defensive, in our opinion, on January 9th, 2020. And if you see, January 9th is fall somewhere here, because we use the structure. We use price structure to see we're going to see a fall here, we're going to see a correction, and we're going to see another fall to match it, because that's how price structure works. And that's exactly what we got. And to add into that, what we saw on Facebook, so this is the Facebook stock, we had the same thing. We had a corrective impulse to the downside following an impulse to the upside. We had choppy price action in the middle, and we knew that we had to see another corrective impulse to the downside or a C wave, which is exactly what we got. And we were expecting it as we saw the break of the highs. Once we saw that, we knew now I was looking for a good time. We were looking for a turn in this area. And with the Facebook, we got it straight away. So that Facebook became a good sounding board for us that the larger S&P was also going to lead to a big sell-off. And as you can see, we have the same ABC impulse, correction impulse in the middle. At the same time, we were looking at Apple. Now, Apple became a bit of a different story because we had this big drop to the downside. We had this impulse to the upside. We had a correction. But the following impulse to the upside really went a long way. But it still matches our criteria because we use what's called Fibonacci extension rather than Fibonacci retracement. And the Fibonacci extension reached the 1.618 level. And as you can see, we drew in this line, and you can go through our Twitter and find the same story. We said we're expecting a big drop in Apple moving forward. And that's what we got. And given the same thing with Amazon, Amazon was a little bit different using the Fibonacci extension. The C wave has turned into a 0.618, but same structure, corrective impulse, corrective price action in the middle, impulse to the downside. Same with Google, big correction to the downside, corrective price action in the middle, big correction to the downside. Same thing, we're expecting Google moving forward to take off and have a nice strong impulse to the upside. So you see the same structure over and over again on the Fang stocks, which make up 21% or something along those lines of the S&P. We see pretty good corrective price action on the S&P, and using the same Fibonacci extension, you'll see that the S&P got to exactly a 0.786 extension of this wave. So these are the tools we use to match our areas, and we knew we were looking for a turn in this area. So it was time to get defensive on the 9th of January, and we got defensive, and we saw a massive drop in the S&P, which turned out to be a 35% drop in the S&P. And from that bottom, as I said, we were expecting a turn around about these areas to match the lows of the A. And what have we got so far? And you can look at our Twitter because we called the bottom in this too. we've seen a 22% rally from these lows. So this technique is way more effective than head and shoulders classic chart trading, and in our opinion, way more effective than Elliott wave. It is an amalgamation of those two, and we found it to be way more effective than those two singularly. So put together, we have a really good methodology. And some trade ideas moving forward. We're looking, and this is kind of matches why we think the S&P is going to rally, because usually when the S&P or the dollar weakens, we'll see a rally in the S&P, because those funds will flow into the S&P looking for yield. And what we've seen in this dollar, this is a basket of 4 of the majors against the pound, the Aussie, the yen, and the euro. This is an index of the dollar, and this is what we're looking at. We have a big corrective price action, we have an impulse, we have a correction, we have an impulse to the upside. We're expecting a C wave to the downside. By the looks of things, we've already got it. And if you had to look on the lower time frames, what you're looking at is an impulse, a correction. This might not be finished, so don't get in short just yet. And what's to follow is further downside. Very clear picture for us that the dollar is going to be weakening moving forward. Saw the same thing with the pound. The pound is looking strong against the dollar. If you look at the Aussie dollar, looks like we've reached a very key turning point here at the bottom. We're looking for a turning point in this area. And if you go into lower time frames, you'll see we've had a strong rally off the bottom and some corrective price action. What looks like running flat there, where this was the initial impulsive correction. We had the middle price action, and we had an impulse from a corrective impulse for the downside. So this is what's called a running correction, A, B, C, off of a lower impulse, and you can expect an impulse to follow. But given the weekly time frame, the higher time frames, it looks like we have a strong move in the dollar moving forward, in the Aussie dollar against the US dollar. And this is backed by what we're seeing in precious metals and commodities, because Aussie dollar is backed with and strengthened by strength in the commodities. New Zealand dollar, same story, impulsive correction, correction in the middle, and we're waiting for the C wave to the upside. A, B, C. US dollar CAD, same story, corrective impulse to the downside, impulse correction, impulse in the middle, and now we're waiting for the C wave to complete. So a lot of indication that the US dollar is going to show some weakness over the next while, next short term. Same with copper. We had a strong impulsive correction. We had a B wave. Now we expect the C wave to follow. And if you go into the lower time frames, what we've seen is an impulse. We still see some more correction on this. So once you see a bit of a move down in copper, that's a good entry for us to get long copper to the upside, with the higher time frames showing that we should see quite a big, strong move in copper. Same with platinum. Impulse, long, choppy, corrective B wave. So we should see an impulse to match this impulse, which we'll see on the lower time frames. Same story, strong impulse off the bottoms and some nice corrective price action in the middle here, waiting for another impulse to the upside. So it's all very clearly pointing a picture of weaker dollar, and the weaker dollar matches our indication that what we're looking at is a rally in the S&P at the same time, which is quite unusual given the macroeconomic events going on with this virus and how the economy is all shutting down. But we've come to see that the charts always tell the truth. So we prefer charts over the news, and we try to use the charts to try and see what news is going to be following that. And just one last chart, it's US dollar, Singapore dollar. You'll see a really beautiful correction to the downside, corrective impulse. You have a corrective impulse to the upside with a nice correction in the middle and another impulse to the upside. So we can expect that impulse to the downside moving forward. And lower time frames, it's exactly what we're getting. Impulse to the downside. We're in the middle of a correction. Not quite sure what this is doing yet. We might have seen the end of it already. And we're seeing impulse to the downside. And any correction like this is a sell all the way down to this 1.3 level. So that, in a nutshell, trying to put probably a month's worth of training into an hour is how we trade and how we get such accurate predictions. And we don't get them all right, that's for sure, because it is more of an art than a science. But I guarantee you, if you keep an eye on our Twitter page and you keep an eye on what we're doing, we're getting it right more often than the likes of Peter Brandt and his classical charting theory and any of the standard Elliott wave guys, because we understand how these two fall together, and we understand price structure is more important than counting 1, 2, 3, 4, 5 waves. And this is a great example of why we don't count 1, 2, 3, 4, 5 waves, because this is an impulse to the upside, right? And if you had to count the waves, we have an impulse, correction, impulse, correction, impulse. All of this is a correction again. Then we have another impulse. So this is a 5-wave structure. I mean, a 7-wave structure rather than a 5-wave structure. And if we were trying to fit this into a 5-wave structure, we would have to curb fit this quite a lot. So we would have to say, okay, maybe this is actually a failure of the downside before, and this is where the starting point occurred. And then you start to curb fit in to try and fit the picture of this, rather than just looking at what you're seeing, which is impulse, correction, impulse, correction, impulse, correction, impulse. So we know every time we see an impulse and we see a correction, okay, here's a good trade to the upside. It's an impulse. We've seen corrective price action, which means probably another good trade to the upside. Price action starts to get quite choppy. Not sure if we would have traded this one, given we've already traded 2 impulse corrections, but it still happens. And there's a trade here to the upside, a small trade to the upside. So that's our picture. That's how we understand these charts. And yeah, we really hope that you guys look into joining us as beta trader testers so we can work together in putting together the best program moving forward and helping out a lot of people with understanding charts. I mean, we find a lot of purpose in helping others taking risk off the table at the right spots. I mean, if you had been following us and listened to what we had to say at these levels, you would have saved 30% of your capital in this drop. So we want to help out people in that manner. We want to help you preserve your own capital and empower yourself moving forward, and not listen to Bloomberg and the talking heads on TV that tell you we're at all-time highs and we need to keep buying into an extremely dangerous area. And we saw that from the beginning of 2019, that we knew moving forward, we were going to see strong move to the upside. We were going to see rallies, but we were also expecting this big move to the downside. And we needed to be prepared for that. So whether it was using put options to keep your insurance or to get out of the right areas, and to know when to look for the downside, you would have preserved your capital and had lots of dry powder to get into the next move to the upside. So this isn't just about money for us. This is about helping people empower themselves and empower their lives and find financial freedom in this lifetime, because it is possible. And we are proof of that. And we just want to help as many people as possible. So if you're interested, again, go to senecalytics.com/beta. You will find the link to join as our beta test. We're going to take a limited number of participants. So we want to get the right group going. And once we have the right group, we're going to put together the program. You're going to help us put that program together. You're going to help us see what works, what's confusing for you, what we need to explain more, and what needs less explanation. And then, yeah, from that, we're going to develop a program, and that program is going to be released at $99 a month, rather than just the $99 once-off fee that you guys are going to be paying to join as a beta tester. So yeah, any questions? Did you guys understand all of that? I mean, it was a lot to take in over a short period of time. So I hope your mind hasn't been frazzled by all of this. And I hope you got the gist of what we were putting out there and what we trying to explain for you guys. Cool. Thanks, Jason. Thanks for the comment. And thanks for joining, guys. Really appreciate it. No, we don't. We use Twitter because it has the timestamp in it. We are starting to look at TradingView as a track record, but we find Twitter to be effective because there's no ways we can manipulate the dates on Twitter to show different dates of what we were saying. And we just find it to be the best platform for following finance, following the global macro. So it works best for us for Twitter to be our main account. But we might be looking at using something like TradingView and the trade ideas on TradingView moving forward. It just takes a lot of our time when we'd rather be spending that time delving into the charts rather than writing up trade ideas on TradingView and adding another platform that we have to follow. So Twitter is our only account. Any other questions, guys? You have any charts you'd like me to analyze? We can analyze it in real time and see what picture you're looking at. Silver is a tricky one. So looking at the higher time frames, we got a really good trade off of silver in the early parts of 2019, late 2018. But as you can see, it's got the same. So we've got a strong move to the downside, and this is what really interested us for a long trade. Was we had this impulse to the upside, corrective impulse to the upside, following this impulse to the downside. Then we had some really good price action. We had the impulse with a correction in the middle, which turned out to be a triangle, and an impulse to the downside. And we had the double bottom at this level here. So we got into silver, we got in at about 14.10 was our entry. And we got some really good trades to the upside here. And same story here. We have the impulse. We have the correction and another good trade to the upside. We expected this to go a little bit higher. So interesting to see us get taken out at such low levels, but we did manage to secure some profits. And now what we've seen, it's difficult to put this into perspective because we've had such a big impulse on the downside. And technically speaking, this is complete because we've broken the lows of the first impulse. So if we are technically complete and we've seen a turn, what we should see And what we are seeing is an impulse to the upside. We've seen some corrective price action. This correction might not be over. We might see this correction do something like this. And then we have an impulse to follow to the upside. So our bias for silver is to the upside, and all we're doing is waiting for impulse correction, and we're trading impulses to the upside. So we're not in this at the moment, but we're hoping to see more of a pullback to match something along those lines. And if we do see that, we know what we're looking at is a running flat. ABC. And an impulse to the upside to definitely be traded with the idea that we might hold that a little longer than usual. So a question here, the corrections after initial impulse vary significantly. How do you ensure risk reward is very good before entering the trade, before the next impulse? Is there any specific methodology? So yes, we'll explain all of this in the course. But basically we use higher time frames to analyze where we expect higher time frame impulses to occur, and then we trade the beginning of the higher time frame impulses. And the lower time frame impulses. For instance, looking at the silver chart, we're expecting a turn in silver at this area. So, and we expect the impulse to the upside to be quite good, because technically, if we go right out to the higher time frames, what we're looking at is an impulse to the upside. And all of this is actually correcting this impulse. And we'll show all of you this in the course, how we know what is corrective and what is impulsive price action. So once this impulse is finished, we should see another impulse to the upside. So what we're looking for is a big impulse, or a higher time frame impulse to the upside. So we know getting into lower time frame, we want to be trading these impulses. So we see a correction. We never just jump into a trade at this level because we think the correction is going to end there. We wait for a turn. And once we see this turn, we wait for the impulse, and then once again a lower time frame correction before getting into the upside. So we'll explain all of this more in detail in the course, but that's how we do it. It's all about managing your time frames and knowing what price action is doing on the different time frames before getting into the trade, and knowing when to enter the trade. Thanks for that question. It was a really good question. And it's one of the key aspects of being successful in your trading. And the key wording you use there is risk reward. So it's all about risk management and how much of your capital to risk in any one trade. And we'll show you the mathematics of the value of risking X amount of your capital in one trade, and how that will help your account grow over time exponentially, and the power of that growth, and how things really start to pick up. So even a small account can be traded, and with exponential growth can really start to see growth at a really rapid pace. No problem. Thank you. Thanks for the question. Cool, guys. Any other questions before we close it up here? So will we take live trades in the program? So I don't want to become a signal service. I don't want this program to become a signal service, but it will be part of the program to show you how we are trading live and what price action we're looking for and where we're looking to get in. But the whole point of this is not for this to become a signal trading thing. It's for you to learn the process so you can take your own trades, knowing with confidence that you've analyzed the charts. So we'll be more specifically focusing on analyzing charts, where you could come into, say, one of the webinars and say, I'm looking at this trade, this is my analysis. And then we can go through that analysis with you and make sure you have the right analysis before entering the trade. And then on that chart, we can say, okay, well, this is the analysis we have, and this would be the area we would look to get in. We would look for an impulse to the upside on the lower time frames, some choppy price action, or a side an hourly, what we call flags, and you'll get in after this flag to trade this to the upside. So yeah, we don't want to be a signal service. We want to empower you guys to make those choices on your own. So if this program shuts down, or for whatever reason we're no longer in touch, you walk away from this feeling empowered to take these trades on your own steam, and with confidence that you've analyzed your charts and you know the process we've used to analyze these charts. Cool. Thanks, Jay. Thanks for the question. Cool, guys. Any last questions before we wrap up? I'm just going to type in the link into the chat. It's in your emails that I've sent. It's also on our Twitter timeline. So go check it out and you'll find the link to join there. What's going to happen is we'll probably join, you'll pay your fee, and then we'll get a hold of you. We'll probably start the process either this week or next week. So it's going to be, we want to try to get off the ground pretty soon. So let us know if that's cool with you, and we'll make a plan to move forward. Is the class on demand, or do we follow a specific schedule? Participants are located in different time zones. How do we coordinate? So that's exactly why we need you guys, so we can start to get the best thing in line. So I'm either going to do live webinar recordings at a specific time and then put those recordings available for the guys that weren't in the right time zones, or I might just go ahead and add to my workload and do, say, a London opening webinar at 8 a.m. London time, and then do a New York opening webinar at the New York time in the afternoon. So there's 2 different time zones that we'll be using. So yeah, to answer your question, not quite sure yet, but we're going to figure that out as we move forward. If there's enough guys in both time zones, then I will definitely put in 2 webinars a day. Cool, that looks like it's it. If you have any questions, you can just hit me up on my email, info@senecalytics.com. You can also hit me up on Twitter. And yeah, if you have any other questions, just let me know there and we can find a path forward. Thanks for joining, guys. I really appreciate it. And yeah, looking forward to moving forward with this. This is something I'm really excited about, something I put a lot of work into. And yeah, I'm really looking forward to giving you guys the skills and tools to really empower yourselves in your trading. So thanks a lot, guys. And we'll chat to you soon. Look after yourselves.